Okay, so welcome everyone to our first webinar of 2023. I think Honchan and myself were already missing coming back and talking about what we love to do, which is advising companies in transfer pricing. So today we have a big group of attendees, and I guess is the reflection of how important tax and transfer pricing has become in 2023 for companies. So before we get started with transfer pricing landscape in Asia, let me just do a brief introduction about our firm for those of you who are new to our webinars. We are a consulting firm that specializes in providing practical, proactive, and cost-effective transfer pricing advice to multinational companies around Asia and or not only Asia, worldwide actually. So we have three offices, one located in Australia, Singapore, and Malaysia, from which we cater to multinational groups around the world in Asia Pacific and other regions. We have been in business already now 15 years plus, and all our team is ex-Big Four with a combined experience of more than 30 years advising companies. Apart from that, we are a tier 2 company in Australia, Singapore, and Malaysia. And we also are very active in contributing in the industry, hence the reason why we do these webinars to contribute to the accounting and tax and finance industry. So for those of you who don't know Hon Chuan Tan is the director and technical lead for Transfer Pricing Solutions Malaysia, with more than 10 years of experience in transfer pricing, with a lot of background on leading firms before setting up one of the big accounting firms transfer pricing team. And now we're lucky enough to have him already with us for 5 years plus. He has a lot of experience in managing and advising clients in transfer pricing and tax in the area of transfer pricing planning, country-by-country reporting, and tax-effective supply chain management in the Asia-Pacific region across various industries. And for those who are not familiar with me, my name is Adriana Calderon. I'm the director and technical lead for our Asia business, co-founder of Transfer Pricing Solutions Asia and Malaysia, with more than 15 years of experience advising multinational companies in the area of tax, international tax, and transfer pricing. I have worked in 3 different regions, and over the past 15 years plus, I have set up or settle in Asia. So with that, let's just get started with what we have for today. So we have some time for questions. So we will be talking about, first of all, the 2023 TP and tax trends. Then we will talk about the specific countries' outlook. And we will finalize with some key actions and takeaways, and we'll allow some time for questions. So, Hon Chuan, time to get the crystal ball out. I hope you have it there, storage somewhere, to tell us a little bit about what are the 2023 TP trends and tax trends that you have observed, and what can we expect for 2023?
Thanks, Adriana. Yeah, I think there are a lot of noises in relation to TP recently. The main focus to be brought in was the Pillar 2 solutions, right? So let's briefly go through the new developments from the OECD, which is termed the 2-pillar solution, right? So the main objective is to actually have taxpayers pay their fair share of taxes, right? Which is obviously the main goal for OECD in relation to TP guidelines and legislation globally. Now, the first pillar, Pillar 1, it tackles the tax challenges mainly arising from the digitalization of the economy, right? So the main focus is the creation of this new special purpose nexus rule, which is the central rule, and the actual sourcing rules. The objective of these rules is to reallocate some of the taxing rights over taxpayers from their home countries to the markets where they have business activities and earn profits, regardless of whether the firm there have physical presence there or not. Hence, the tax challenges in terms of digitalization of the economy, right? So obviously, the scope of Pillar 1 for now is actually very high, which is revenue above 20 billion euro, right? Which only applies to 100-ish companies globally. And obviously, we know where most of the conglomerates lie, right? So for now, Pillar 1 generally will not apply to like almost 95% of the economy anyway. But that would be the start of tackling the tax challenges for companies within the digital economy. Now, the next pillar would be more involved, which is known as the GLOBE rules. It translates to Global Anti-Base Erosion Model Rules. The objective of this pillar 2 is to apply a global minimum corporate tax, which is at 15% at this point, right? So it means, it sort of means that if the tax paid by the M&E groups on profit in the jurisdictions falling below the minimum 15%, then a top-up tax would then be imposed to bring the overall taxation profit up to the minimum rate of 15% overall, right? We're looking at effective tax rate of 15%. Within this GLOBE rules, there are two mechanisms in place which will be used to determine this top-up tax, right? Which are, first up, income inclusion rule, which involves having the top-up tax to be imposed on the parent entity, right? Or the under-tax payment rule, which involves the denial of deductions or any adjustments to the low-tax income entity, right, in the low tax jurisdiction, to the extent where this entity is not subject to tax under the income inclusion rule, which is the first rule. Now, for the scope of Pillar 2, the threshold is actually European 750 million, which is actually similar to the CBC ruling, right? That's for Pillar 2. Now, in Malaysia, we envisage that the GLOBE rules will be introduced in the upcoming budget, right? That's where the crystal ball comes in. As actually, there was a public consultation paper seeking for opinions in relation to the GLOBE rules to be introduced in the budget 2023. Obviously, we are not too sure what will be the effective year that it will be introduced, so that's yet to be seen. And on top of these GLOBE rules, they might introduce another rule, which is called a qualified domestic minimum top-up tax rule, right? So this will be in relation to domestic entities, domestic activities, which will then need to assess once the budget is out. Hopefully, that there won't be much disturbance to the transfer pricing position in Malaysia, right? And I understand that the budget came up recently for Singapore, if I'm not mistaken. And what was the take on the two pillar solutions in Singapore, Adriana?
Well, the take is that it will be implemented in 2020, from 2025 or 5.
Yeah.
There hasn't been any comments on the fact that we may change the threshold of application like Malaysia has, but I wouldn't be surprised if even if Singapore doesn't take that approach, other countries in the region, if they decide to go ahead, they may take the approach to lower domestically the threshold, because a threshold of 750 million euros, which is the equivalent of 1.1 SGD, is quite high for other countries in Southeast Asia like Malaysia, Indonesia, Thailand, because obviously of the currency exchange, etc. So I wouldn't be surprised if other countries, if Malaysia take that stand, if maybe other countries do the same, to be able to effectively have some practical application of these rules.
Yeah, I think that's a very good point, because I think one of the queries raised in the public consultation paper was that whether the threshold, which is the euro 750 million threshold, should be lowered to a certain extent, right? So we'll see in the budget 2023 and see whether that they would actually lower that. So let's hope they don't. Well, for the taxpayers' sake. Now that brings me to the next question. With the introduction of Pillar 2 at least, what kind of potential outcome or implication that we may face this year, next year, or 2025? What the first thing would be, what we anticipate would be a change to the TP policies, so overall TP policy for the group, right? Where taxpayers will then need to relook at the overall real-time transactions, the arrangements under those jurisdictions that are affected. So if you come under the purview of the GLOBE rules, and that you have jurisdictions that are affected by the global minimum tax, and then you most likely will need to reassess your policy. And which leads to the second point, whether a potential restructure will take place with proper TP planning, right? So if you have jurisdictions that are affected, then you need to relook at your structures to ensure your policies and your structures are not caught out by the GLOBE rules within the global minimum tax. And thirdly, which is an interesting one, a potential spin-off from global consolidated group to smaller groups to be below the current threshold of euro 750 million. Obviously, that depends on the actual threshold to be made. Hence, taxpayers would not then be under the purview of the group rules if they're spinning off their consolidated group into smaller groups. And then lastly, most likely there'll be a potential tax wars between jurisdictions to obtain the fair share of the pie, right? So it'd be interesting to see whether there are any countermeasures that would be introduced by the respective tax authorities globally.
One of the things that it is going to become quite difficult from Southeast Asia is attracting businesses only based on incentives, on tax incentives. If Globe goes ahead full steam, I think countries will have to consider from policy point of view, what else can they offer other than tax incentives? And then the other thing is obviously, if the threshold continues to be as it is, then one potential option for taxpayers is what you were saying before, which is trying to separate consolidated groups to not be within the scope. But that may not work if all of a sudden different countries decide to use different thresholds. Then it will make it a bit difficult. So Hong-Chan, also it would be interesting, apart from this the biggest development, and for those who don't know yet, we're going to have a dedicated webinar in March to the global minimum tax provisions, and we will work through how they work, and we will give some examples, so stay tuned and register for it. But as this webinar is focused on trends and outlook, what else do you see in terms of changes on the focus points on TP, and what have we been observing lately?
Yeah, so I guess we've gone through the legislative or development in potential development in TP, but then we drill down to the practical focus or practical experience that we have faced at we will think will roll over to the coming years. Now, we have had our fair share of audits last year, and what we have witnessed so far is a shift in focus from compliance to further scrutiny on the substance and processes behind the related party transactions or the overall transfer pricing position. Now, from what we have experienced, gone are the days where the TP documentation is sufficient to defend against your transfer pricing position, right? Last time, you can just provide your TP documentation to the tax authorities for the review. And in the review, they will have a checklist for each section to make sure that they take all the checklists for the material transaction. Benchmarking has been performed, checked, and then markup may be within the interquartile range. And then at the markup stage, right? Obviously, this phase they would have their own set of benchmarking then to adjust you upwards, right? So normally when they come in, they would have in mind a potential adjustment, right? They won't go away without any adjustments, so to speak. And that's where the war begin, right, between the taxpayers and the tax authority, right, on the benchmarking and making sure that you justify why it's that interquartile range, what comparables were used. Now, it's a different ball game altogether lately. Obviously, you still have your TP documentation, right, which may be your first line of defense or maybe not, depending on how your TP documentation was prepared. Having a contemporaneous TP documentation obviously will still provide you that penalty protection. In Malaysia, that's like 10%, right? Now, here's where it gets tricky. After the first round of the TP documentation, then the tax authority will actually look at TP documentation, and the next round, they will have a template questionnaires for the relevant transactions, seeking to assess the substance and economy reality of those transactions, right? So that is when the justification begins, right? So it goes from a overall TP documentation to the end markup to a process-based audit. I'll give you an example of what we have faced earlier last year, where we have a client. It was actually long-standing client where we already have had numerous audits previously done, and everything seems pretty textbook. Everything was fine, and the last audit that we have had have a very different tone. I think borderline aggressive from the tax authority, where there were a lot more queries raised in relation to providing evidence to prove that services were actually rendered, or showing how transactions were captured in the accounting systems and what was the result after churning out from the accounting systems. Then basically they are honing in from every angle for you to prove the existence of that transaction. Now, the good thing about this client was that we started off with a TP planning, which was the recommended starting point within the TP cycles that I have mentioned in our previous seminar, right? With the proper processes and then implementation. After implementation, you have an annual review on the outcome. And the key thing here is that the good governance from management is one of the key things to make sure that all of these are performed consistently, right? And the verdict was that nothing was adjusted. The tax authorities was actually blown with all the data that they were able to actually provide them, with papers, all the evidence into proving the existence of the transaction. And obviously it doesn't stop there, right? You still have to then go through the markup, the cost base, everything goes hand in hand after that, right? So to wrap up, or rather to actually point out the objective of this section, is that it's actually crucial to have a robust implementation control and processes in place, right, for your related party transactions. And then having good governance to properly manage these processes and making sure that these processes are, put in place. And then obviously compliance will be the least of your concern when you have all this in place, and making sure that, yes, I've implemented, I've my own processes in place, and I've got employees, management to make sure that these are sustained yearly. I think the most important thing here is that it needs to be sustained yearly, right? Sometimes it's good to invest in all this implementation, but then I've seen taxpayers where have done all the hard work, but then year on year it becomes less reliant on, and then none of this will be reviewed, and errors or inconsistencies will arise when we have to have good governance to make sure that these are properly managed.
Thank you, Hongchuan. I think that actually is very similar to our experience as well here in Singapore, in Indonesia, in other places here in Southeast Asia. A lot of focus on making sure that we can prove that whatever is being said in the TP documentation is actually happening in reality. So I think for that, having robust processes and controls is quite key. So what do you think is apart from GLOBE, which we already know, and Pillar 1 and Pillar 2, what else do you think could come in terms of legislative changes? And what are the trends on this?
Yeah, I think more or less of our observation throughout the years from the time 2012 in Malaysia, there was the TP guidelines were introduced until now, right? You can see the trend on the development of these rulings, not just in TP, but tax and other areas where we can see a trend towards transparency, right? More data nowadays are required to be disclosed in relation to your group, your local entities, subsidiaries, permanent PE, permanent establishments. Data such as detailed financials, assets, number of employees, activities within the supply chain, almost everything that in relation to your group will need to be disclosed, right? And that increased transparency, and with the current digital environment, tax authorities are also sharing information with each other, right? With those utilization of those data, they can actually pinpoint risk areas within your group at a glance. It allows tax authorities to actually quickly identify and respond to any tax risks. Now, especially when you have aggressive tax planning, which were rampant before these legislative changes, where you can have your aggressive tax planning to be to actually shift profit to another jurisdiction. But when you see this type of development regarding the two-pillar solution, it more or less hone in on all the gaps, loopholes that were readily available, especially for the bigger multinationals to actually exploit. Now with this new development, obviously it creates a burden to smaller taxpayers, which were actually not really doing all this aggressive tax planning. However, unfortunately, that will stay within this TP environment. So it's actually important to keep in mind that if you're a taxpayer that have these tax planning in place, you'll most likely fall into their radar and will actually create a trigger to the tax authorities.
Thank you, Hongchuan. So I think the hope of asking to provide less information is probably not going to be there. I think what is happening is actually, for some reason, tax authorities think and governments think that there is a correlation between asking more information and reducing the possibility of tax avoidance, which I'm not sure if there is a correlation there, but anyway. What about audits and disputes? What is it that you have seen lately in terms in the region about audits and disputes? And what are the highlights? What are the highlights in your experience?
Yeah, obviously that's the scary part in audit or tax compliance, where as I have mentioned earlier, the dynamics of audits and disputes have evolved over time, right? I mean, it's not just the legislative changes; it's more towards the knowledge of tax authorities, tax officers, right? They're gaining more knowledge and they're more competent in identifying all these risk areas and actually drill down to those risk areas, right? So now we are now well within the post-pandemic phase, and hopefully the opening of the China borders will not have changed that, but instead boost all the global economy. And pre-pandemic, government reserves globally would have suffered greatly, right, during the pandemic, with all the handouts, subsidies, grants to safeguard their economy, making sure that all the economy doesn't fall down one go. And now, post-pandemic, they will need to get back those fundings, right, from different channels. So, which result in an increase in audits and reviews. And obviously that's expected, but not only that, taxpayers will be faced with more sophisticated questions and investigations, as I mentioned earlier, and they're requesting for more evidence on implementation and substance, right? So the more they audit, the more knowledge they have, right? The more knowledge they have, the greater the scrutiny it is. So which means that there are taxpayers that has been dodging the TP compliance or more or less waiting for audit to come in. So there are a lot of developments in place. I'm sure you guys are aware of the Malaysian penalty development as well. Increased penalty, reduced days to prepare, right? These are more or less the measures that are put in place for them to actually meet their KPI, and obviously getting taxpayers to pay up, right, for those that are not compliant. And an interesting observation from last year seems to suggest that there are much higher budget provided to tax authorities to actually conduct audits and disputes. So that's where you would think that you may be on a smaller scale, small and medium taxpayers, but now they have more resources to actually capture you guys, because they have their own KPI, and they know that they would be able to get more from smaller and medium taxpayers, because these are the groups that are unfortunately burdened with rising costs, which means lacking of all this governance and TP documentation. So that's where the risk area lies. And then the next thing is, nowadays taxpayers, in particular those that relies on master file information or group level information to sort of be their TP documentation, so to speak, you need to be mindful that you actually need to document and review your local detailed information, right, in your local TP documentation to ensure consistency, right? It's the responsibility of the local entity to make sure that the local documentation are properly documented, and the local directors are accountable for this, right? Please be aware that the directors are accountable for what is documented down in your local documentation, and there are also penalty for directors as well. lastly, dispute resolutions, right? So dispute resolutions avenues to taxpayers are still ineffective, meaning, for small to medium taxpayers, where you have tax dispute resolutions such as your advanced pricing arrangements (APA), mutual agreement procedure, which is an MAP, and voluntary disclosure. Right, from these, more or less, you can only rely on the voluntary disclosure, right? While the APA and MAP are more towards when you have transactions that are complex or high value, only for the tax rate authorities to consider. So with the lack of dispute resolutions, it's really tough for small and medium taxpayers to rely on.
Thank you, Hunchun. I think the fact that we do still have not very effective avenues for the majority of the taxpayers, not so much in terms of materiality, but in terms of size, I think it makes it a bit difficult to handle some of the issues that happen in each of the local countries in the region. So how do you see are the outlook and the challenges for the tax and the TP teams for the coming years? What do you see that is some of these struggles?
Yeah, I think one of the challenges that taxpayers may face are the lack of staffing, specifically staff with correct skill set to manage the tax function. We can observe global layoff by huge multinationals. The latest hit I've seen was Google in Singapore, as a measure to withstand, the possible global recession. Right, this results in staff wearing multiple hats, which can be risky to ensure good governance and to make sure that they are compliant first up, and that all these processes, applications are put in place. I think your screen changed to Excel. So yeah. Now that shows staff wearing multiple hats, doing multitasking at the same time. So I mean, if that staff with the correct skill set is there, then that's fine. But more or less, I think we have seen staff that have less knowledge in tax that are managing the tax function, which can be risky to companies. So obviously, it's not because of the fault of companies, but it's due to all this global recession, cost-cutting measures by the management team to ensure that their company stays afloat, right? Their business to have. Then the next thing is we are also seeing business models rapidly evolving to accommodate the also rapidly changing economic environment, right? So we have business evolving their business models, but at the same, as opposed to you have development in TP or legislations in tax, slow development that may have archaic solutions that may not have the solution to the new business models, so to speak. So by the time you have a new legislative development introduced, your Pillar 2 solutions, for example, you would have another business model to deal with, right? So then we are more or less stuck with the old ways with a new trend, right? Hence, I guess we have to be a bit more creative in using the old ways to deal with the new trend. Then, which leads to what are the creative ways actually to accommodate this. Now, the outlook would be to embrace technology and AI. I'm sure you guys have heard of ChatGPT. I'm sure there are a lot more AIs coming up to accommodate the lack of staffing And that could result in more advanced systems and maybe automation to tackle implementation issues. Thinking aloud here. And then that depends on the jurisdictions they're in, right? So when I'm talking about Malaysia, for example, this may not happen so quickly because I mean we still have our labor, right? Our labor are still on the lower cost areas where it may be more affordable to hire more staff than invest in these technologies. So I don't foresee this type of embrace in technology so quickly, but that may be a different story for Singapore, right? With the high currency or expensive labor, that would be a different avenue for Singapore. And obviously this is like a vicious cycle, right? It's because of we have like inflation, we have cost increasing, hence cost cutting measures are in place. Hopefully, well, I guess I don't foresee going forward this will change. I think it'll get worse until we have a global recession, then the whole cycle comes again. And we'll see how it pans out in the coming years.
Thank you, Hunchon. I think always support functions that are understood as cost rather than bringing revenue will always suffer because of inflation and rising costs. When if everyone is trying to do more with less, then the obvious sacrifices are sometimes on the teams that are support and not revenue generating. So I think that's one of the biggest challenges of TP and tax, which is seen as not revenue generated, but rather than a cost for companies. So let's talk about the different countries highlights. So everyone get a bit of a understanding of how the countries are looking at TP for 2023. Well, we will start obviously with Singapore, and I can give some points on here. Basically, there is an increase in audit activity. So since 2016, every January, we always receive a significant amount of queries from IRS on conducting TP audits. One of the industries that we have seen the most have been commodity sector and technology sector. There is a lot of focus from IRS on enforcement of contemporaneous TP documentation to the point of wanting to understand when was the TP documentation finalized and signed. So they want to see that date, and they want to see that that date is before the lodgement of the tax return. Similar to what you said earlier, there is extensive information requests during audit focus on both the documentation aspect, but also the implementation, how you prove that what you're saying in the documentation is what is actually happening. Apart from that, there is expectation for taxpayers to have documentation and contracts in place. Contracts has been something that have been somewhat overlooked to some extent in TP, but what I have noticed is that, and funny enough, majority of the e-tax guides do not say anything about the need of contracts and how is it only mandatory. But every audit, the first thing that you get asked is about the contract, because any transaction is enforceable if there is a contract. So that is not, that is something that applies in intercompany transactions as well. And we have that we spoke about the enforcement of globe minimum tax rules, possibly since 2025. But I wouldn't be surprised if Singapore stay in a wait and see mode, because they don't necessarily will be the pioneers unless there is enough enforcement in the region. So what are the highlights on Malaysia, Hon Chuan?
Yep. For Malaysia, I guess for everyone, increased audit activities, definitely. Expectation for taxpayers to have TBD and contracts. Yes, as Adrian has mentioned earlier, contracts though not spelled out in the text of TP rules or the guidelines, but it's more or less a requirement to have that in place. Talking about enforcement of contemporaneous TP documentation, for now, we do not have that enforcement, but I've had taxpayers asking, oh, we get backdated. I think there's one of the enforcement is that the tax authorities will start scrutinizing as to, provide me evidence that you have finalized this date, or you show me what when was the last change date in your TP documentation to prove that your TPD is actually contemporaneous, right? And thirdly, focus on limited risks. Yeah, as you know, Malaysia is an area of support services, and looking at ensuring that these entities are being remunerated accordingly. Generally, limited risks would mean that they would have a fixed margin, and then looking at also outbound payments as well, to sort of see whether there are any leakages for those outbound payments. And then the fourth one is not acceptance of profit split. To emphasize, it's not that they don't accept, more like, yeah, you can have profit split, but it's sort of made redundant because under the profit split methods, within the guidelines they sort of stated that yes, you can have profit split, but then you need to have a benchmarking performed, which is more in line to the TNMM, to make sure that you're still being remunerated accordingly based on the activities that you have performed, on top of the residual profit. And then more questions on TP and tax returns. Yes, so on top of the increased questionnaires and whatnot in your audit, this is more towards your tax return form, where there are more questions in relation to your transactions that needs to be disclosed in the tax return, right? So please be mindful of that when you have real-by transactions, that you have more things to fill in within the tax return for Malaysia.
Okay, so let's talk about next Indonesia, which is a very, very high activity country where there is a lot of audits being conducted, especially when the Indonesian taxpayer transacts with a lower tax country like Singapore. There is a lot of focus on services to reject deductions, and then taxpayers, what we have observed is that taxpayers have to really go way beyond TP documentation to prove that the services provided a benefit to the Indonesian taxpayer. Otherwise, there is a rejection on the deduction. So that's where the implementation part becomes really important, to prove every single aspect of how the service benefit the Indonesian taxpayer. They also focus a lot on the importance of having contemporaneous documentation. And interesting, in Indonesia, that means documentation and benchmarkings that are prepared at the time that the transaction is set up, not by the lodgement of the tax return. And that is very important, because if the tax authority realized that the analysis was conducted after the transaction is in place, there is a chance that they reject the data that supports the pricing. There is a fourth very important outlook, which is the fact, or development, which is the fact that TP adjustments can lead to secondary adjustment, and secondary adjustments can be deemed as dividend payment, because it is if the TP adjustment is as a result of coming from profit and it results in a secondary adjustment, then it can be categorized under Indonesian domestic rules as a deemed dividend. And if you categorize a payment as a deemed dividend, that payment will be subject to withholding tax. So that's something that is very unique to Indonesia. There is also pre-audits and compliance checks that involve basically requesting from the taxpayer the documentation as soon as the tax return is lodged. So in other countries, we're used to the fact that, okay, the tax authority has maybe 3 or 5 years or 7 years to come for an audit, and they don't necessarily focus a lot on pre-checks. So in other words, if I lodge my tax return in Singapore in November, the chances of the tax authority asking me for my TP documentation in Jan for the same year that I just lodged are rather slim. Seems like in Indonesia, there is a trend to make sure that before you go to audit, check that the documentation is ready as soon as the tax return is lodged. So that's something that is important because that makes the deadline for completing documentation very, very tight and means that you really have to be ready by the time the tax return is after the 3 months after the end of the financial year, which is when in Indonesia the tax returns are lodged. We have in Philippines that despite of Philippines being one of the late adopters of the country of the T-tier approach to TP documentation, now they do have TP provisions in place and there is audits being conducted. And I think there is a couple of things that in general in Southeast Asia and in Asia, countries are struggling to understand. One is the application of residual profit splits methods. And if you have payments that extract residual profit, which is profit that goes above routine profit, how do you treat that payment? Because in theory, if it is a profit payment, the question is it in the form of a service or should it be a royalty? Or if it's profit, then how it should be treated? Because if it's profit, should it be deductible for the payer? So that is a point that is being investigated in Philippines. I think that is a result of the fact that, like Malaysia or like Indonesia, Philippines will have a routine entities and limited risk entities. And then obviously there is a focus on making sure that if those limited entities are just receiving routine profit and they are stripping out the residual profit, that they are done in the proper manner and with some basis. Otherwise, it's like you're stripping profit from the country for no reason, which is why that we will have lately an increase of TP audits, and then the importance of having that TP contract, and TP documentation in place to explain if there is a residual profit split, how this profit split is being conducted, or even for any other methodology. We have Vietnam being another very aggressive country that focuses a lot on the need of local comparables, no matter what. And also the importance of having contemporaneous documentation plus contracts in place, and in the documentation, if the entities are subsidiary, very focused on local comparables. Outbound payments being a focus point as well. Outbound payments in the form of services, royalties, or even profit splits or residual profit splits or TP adjustments. To make sure that this is not being used as a way to strip profits out of the Vietnamese taxpayer, and review of recurring loss makers in combination with outbound payments. We have Thailand, that Thailand was also a late adopter, but also very focused again on the residual profit split issue, focus on local comparables, also enforcing the need of having documentation and contracts, and having a lot of issues around the possibility of stripping profits out of the residual profit split method because of the reason that I was saying earlier, but that there is maybe local provisions that do not allow for profits as a result, payments as a result of profits to be deductible, or maybe be subject to withholding or be categorized as dividends. Hence the reason why loss makers, outbound payments, year-end adjustments, in combination with tax refunds can be very risky and lead to audits. In Thailand, we have, similar to Vietnam as well, we have a very extensive tax return questions associated with related party transactions, which give the tax authority a lot of visibility. We have India, that India is another country that is very aggressive with a lot of, I think it's probably the country with the most number of litigation cases associated with transfer pricing. So if anyone wants to know anything about any topic in transfer pricing and how it's treated in court, the Indian court cases are the way to go. They focus a lot on local comparables. They focus on contemporaneous documentation, focus also on outbound payments, recurrent loss makers, and there is a very complex landscape in terms of the number of reporting forms that needs to be done during the tax return that are associated with related party transactions. So there is like 3 or 4 forms that needs to be completed as part of the annual compliance that are related not to corporate tax, but to TP alone. We have Cambodia that it has been not a very early adopter, but we have that they are focusing again a lot on making sure that there is compliance with the transfer pricing provisions. They don't have thresholds for documentation, so any taxpayer that has related party transactions will have to have the documentation. And similar to other countries, we have very big focus on outbound payments, year-end adjustments, tax returns, and review of loss makers, which actually, once you see all of these, you realize how Southeast Asia in general is focusing a lot on defending their tax base by challenging a lot of the outbound payments that go from subsidiary to head office. And I think that's what the countries have in common, and that they are trying to make sure that their tax base is not compromised and that profit that should stay in the country doesn't go out by way of payments, which is why it's so difficult to go down the path or down the route of a profit split in Asia, because it's very hard to get it across the line with the tax authorities. And that is kind of in contradiction with the GLOBE and the Pillar 1 and 2 rules that tend to be more focused on profit splits. So I don't know how Southeast Asia is going to reconcile that. There will have to be some change of a mindset when it comes to TP if we were going to reconcile those differences. So I think with that, we're pretty much done with the country highlights. Do you have any final remarks before we go and look into the questions, Honchan?
Well, I guess I'll just have my key takeaway for this session, which is still having good governance in place. I think that's more or less the key area that taxpayers will need to focus on top of their compliance work, right? You just can't just get that compliance in there and not have good governance to make sure that it's maintained and managed properly.
Yeah, I do tend to agree with that, and I think watch out the developments on tax. At the moment, I feel like we are all going on the basis that, oh, these rules apply to very big multinational group, but we need to really keep an eye on the fact that on whether the thresholds are going to be reduced by countries by domestic law.
Yeah.
If anyone has any questions, you can put it in the Q&A chat. There is no someone is asking when is Pillar 1 going to be implemented? What is the impact of Pillar 2 on TP for Singapore? So Pillar 1, there hasn't been any comments on Pillar 1 yet. Everything of the budgets have been focused on Pillar 2. The Pillar 2 impact on TP for Singapore, it will be probably that if it gets implemented as it is meant to be, as the rules from OECD, then any company that is within the scope of Pillar 2 will have to relook at their receipt or their profit allocation based on traditional TP and compare it with what it will be under Pillar 2 and whether there is some adjustments that need to be made or not. Because if your TP position is very aggressive, in the sense that it gives you an effective tax rate below 15%, there is a very high chance that you're going to have to pay a top-up tax. And then the question is where. So I think that's the impact for TP, that you will have to see what's your position under your normal TP model and what will be your position under Pillar 2. And whether you will have to be subject to top-up tax or not, and where. Okay, I think there is no other questions on chat.
Yep.
So please follow us on YouTube. All we want out of our webinars is followers in our social media channels. We will be back in March, April, and May with one webinar each month. Hongchuan, we have a busy schedule from the looks of it. We also have a class coming tomorrow. With the Malaysian Institute of Accountants, where we will be talking about transfer pricing essentials. We have also a few other classes organized in Singapore with the Institute of Chartered Accountancy, with a private institution called TASK. So keep an eye on our social media channels because we are always doing stuff apart from our consulting work.
Yep.
So with that, thank you very much, everyone, for attending our webinar for today. And we will see you soon. If you want to reach us, you can find our details here.
All right. Thanks. Thanks, Mariana. Thanks, guys.
Thank you.